Okay, welcome everybody to episode 89. I've got the red light of death behind me because it's a market crash. You might have noticed that I actually changed the thumbnail, and I also completely have basically called an audible on what I'm going to be talking about today. So if anybody was a little bit confused, if you're at the right live stream, yes, I was going to talk about two other subjects, but we can do that on a calmer day. Today, the market is absolutely crashing, so I thought we would have kind of an emergency meeting and talk about things that you really only get a few chances like this, right? The markets have been stable for so long. It's been very boring. We've been in the same positions for so long, but now there's actually a little bit of excitement. So pretty cool. We can actually highlight a few trades. I know people are looking to do some VXX trading, UVXY trading. Days like today, buy and hold investors are probably just watching in horror, hoping that the market doesn't fall off a cliff because they don't really know what to do. But for us traders, we always do like to get in there and, get a little action. So today is a very, very interesting day. So the first thing, of course, as always, I want to remind everybody that half of you who watch my videos are actually not subscribed. So make sure you subscribe to the channel. Talking about volatility stuff, talking about investing. So if you like this type of content, go ahead and hit that subscribe button. It is free. Also, reminder, don't send any super chats. If this is your first time here on my live streams, it's all free. It's all open. You can ask any questions you want, and don't use the super chat. Don't send me any money. It's all free. And beyond that, of course, give the video a like. And I see some questions coming in. There will be a Q&A, of course. That's what probably there's going to be a lot of questions on a day like today. Pretty crazy stuff. But yeah, go ahead and do that now. Or as we're talking, I actually just whipped up my original rundown, looked like this, but on a day like today, no reason to talk about those. So I actually have a little bit of just a last minute, just about an hour ago, I switched everything. So what we're going to try to talk about today is maybe some ways to trade this thing effectively. If you're looking to fade this volatility spike, which is typically, volatility spikes like this, we all know what VXX looks like long term. So of course, people are going to want to, buy the put options. I'm going to talk about that. I might get to this topic. I think it's actually kind of interesting today, but maybe we could even push that one if we're running low on time. And then again, this one, well, I'll just keep an eye on the time, but lots and lots to talk about. So first thing, of course, is the number one thing that I see when the market crashes like this. First of all, just shout at me if the sound is broken. My technical difficulties. There's something's always going wrong, but let me know. But the thing that I always notice, and I'm always on Twitter on days like today, always interesting to see people, their takes on everything. And it's just an overwhelming number of people always talk about how they're going to buy VXX put options, right? That's how they're going to profit from the eventual decline of this thing. We all know what it looks like long term. This is the VXX. Of course, the UVXY should be somewhere here. Going to look like the same. So whatever your product of choice is, whether it's the VXX, the 1 times long, the UVXY, which is 1.5 times long, if you really want to go crazy, the UVIX, which is 2 times long, whatever it is, they all look the same. They do decay downward over time. So of course, just a glance at that chart, people are thinking, well, the VXX spiked, and actually at one point today it spiked over 25%. Of course, what we want to do is just buy those long VXX put options and wait for it to go down. But I want to try to remind people that on a day like today, that type of trade is actually dangerous. Even though overall I agree with the sentiment that yes, at some point the market's going to stabilize, VXX will bleed down, and there is an opportunity to make some money. Problem is, let's just get rid of that. The problem is we are option trading, right? And options have Greeks, right? There are many variables that are going into these trades. You can't just look at it as a pure price trade. If you're just trading price, there's nothing wrong with trading the ETFs directly. But you got to remember that when you're dipping into the options market, you're talking about multiple variables: time, volatility, all the time frame, the premium that you're paying. All of these things matter. Now, there's a lot of Greeks. They all mean different things. You don't really have to focus on too many. There's actually only 3 that you really have to know about. On pretty much every trade, you're going to check those 3. So you're going to check the delta, the theta, and the vega. But on a day like today, let's just check where we're at. Market's down 2.2%. Something like the VXX, I mean, it's probably getting pretty ugly at this point. What is the VXX right now? Up 22.45. So on a day like today, it's a day about volatility. And volatility, whenever you think of that, just think of Vega. So today is a Vega day. You want to be careful about the Vega. Now, what is Vega? Just a quick little recap for everybody. Vega measures the sensitivity of an option's value with respect to volatility. So, given a 1% change in volatility, Vega shows how much that option contract is going to change, either up or down. Now, long put options are Vega positive trades. So, if you enter a long put option on the VXX thinking that eventually it's going to go down, you have to understand that you're buying volatility when it's extremely expensive. And what could end up happening, and it often does, is people will buy the VXX put options, probably give themselves some time, 3-4 months, something like that, and maybe you're going to be right, and maybe the VXX does decay down. But when that happens, oftentimes option traders realize, wow, I didn't really actually make any money. And the reason for that is, even though you got the direction correct, which would be the delta, directionally you got it correct, that VXX goes down again and you think you're going to make your money, but that Vega gets pulled out of the trade as well, and the Vega can actually override the delta, and even though you got the direction right, the volatility still hurt you, and you can actually lose money. So the VXX is what, it's 60, something like that right now? Let's see where it's at, just get the numbers correct. 61.59. If you open a trade and it goes back to 40 or 45, you could still lose money. So what I wanted to try to do today is, first of all, I am going to open a VXX trade, but I also want to open 2 others, and maybe we can just do a head-to-head. I'll keep them open in this account, and every so often we can come back and check to see how they're all doing. So the first one, let's go ahead and open a VXX put option. I'm just going to check the stream here, see if anybody's yelling at me. Check the questions. There's a few there. Okay, we're all good. So what we're going to do is let's just open, I don't know, $500. So you would go over here, you'd go to the VXX. Let's choose an expiration date. So I would imagine that most people are probably thinking October or December. I want it to happen a little bit sooner so we can talk about it in the live streams, but let's go ahead and use the October. Now, quick reminder, there was a VXX reverse split last week. We did a live stream about that. So when you look at all of these numbers, of course, you're looking for the ones that say 100. You don't want the ones that say 25 over 100. Probably couldn't open them anyway, but those are the old option strings. You want the ones that say 100. That's the new options that the market makers are now focusing on. And these old ones, they will stay there for a long time until they expire, but they're out of our, we don't care about those. So this October with 100, here it is. So if you're opening a put option, I'm just going to try to do something that I would imagine most people are going to do. Kind of an average of what? Like some people might go at the money, some people might go in the money. But I suspect most people are probably thinking out of the money, right? So I'm just going to find a put option, the 50, because the midpoint, I'm just basically trying to get $500. So I could either go a 250 option, which would be the 43, or a $5 option, I could do the 49. So kind of don't want to do the 49. Let's do the 50. I think this probably represents what a lot of people would be thinking. An out of the money option. Let's go to the VXX chart. It wasn't that long ago that it was at 40. So first of all, we can actually just mimic this trade. We can actually check the 50, and you'll get a picture of why this might be something that people are thinking about. So this is what that's going to look like. Price is right here, but it wasn't that long ago that the price was actually down here. So give it 3-4 months, maybe people are thinking it's going to go right back down to there. So that would be a good trade. Let's go ahead and buy 1 contract of this. I would do what I call the 30-second rule. Especially since these options are fairly new, the liquidity might not completely be there. We don't really know what mid price we're going to get, but let's give it a shot. So the mid at 610, 30-second rule is essentially when you're trying to maximize your fill prices, you don't want to go directly on the mid. You want to kind of try to get a price that's a little bit better because your software might not show it accurately. So if the mid is 610 and it's a long option, let's just go 6, right? This is what it would look like. Move that out of the way. 1 contract, and Oh, there we go. So that's why we would do the 30-second rule. I'll explain what I was going to say. If you don't get it, these are computers. It happens very quickly. Of course, we got that one. But you'd basically just sit there for 20, 30 seconds. If you don't get it, adjust it the minimum increment. So sometimes it's 5 cents. Sometimes it could be 1 cent. But you just adjust it one increment, wait another 30 seconds. You're going to get your options filled efficiently doing that. So that's the 30-second rule. As it turned out, we got it right away. So that's the first one. What I wanted to introduce, though, is the second trade, which would be a vertical spread. So we're going to close this one. Remember, this trade here is extremely Vega positive, right? So you're opening it on a day where volatility is extreme. You've got to be very careful with that trade. I'm not expecting this one to be a very good trade. Probably just wasted that money. But if we do a vertical spread, I want to show you what a vertical looks like. And the only difference, it's the same directional exposure. The only difference is this one, if you'll notice on the bottom, is comprised of both a long and a short option. So that's a vertical. Now, I wouldn't do a 50-49. I would do something like a 50-45. And it's going to look like this. Price is here. It was recently at 40. So this is very realistic in 3 or 4 months to expect it to go back down to there. But what I wanted to point out is the Vega differences. So this is the long put that we opened. What did we get? 6. This is the long put. Now, if I go over here and adjust the Vega, look at how high the Vega is on one single contract. We're talking about $8 or $9 per contract. If we go to the vertical, I don't know what I'm going to get, but let's just assume it's there. If we go here, look at the Vega now. It's less than $1. So this is essentially what's happening when you combine a trade with both a long and a short. Now all of a sudden, it's not nearly as strong a volatility trade. It is much more directional. So whenever you're trading something, let's say volatility is extremely low, that would be a good opportunity to buy a trade that is directional, but also get a little bit of positive Vega. Because if volatility is low, it doesn't, statistically, mathematically, it probably would go up, doesn't have a whole lot of room to drop. But when you're opening option trades during very high volatility, you do not want to open very strongly Vega positive trades. If anything, you want to be Vega negative, because of course we're expecting it to fade down, volatility declines, and you can be right directionally and volatility wise, and you can actually have a much more profitable trade. So just remember that options trading is not always about direction. You have to, price, volatility, time. There's many, many different factors. So this vertical trade is actually looking much better, isn't it? And then you just have to decide where you're going to go exactly. I think this looks reasonably okay. Again, I'm trying to weight them all equally, so let's go slightly over $500. And let's do same, but I can't use the same strike, so I'm going to use different strikes here. Let's do 45.40, just because, okay? 45.40, vertical spread, looks like the mid is 180. I'm not gonna do the 30-second rule, but if I was just trading on my own, of course, I would probably try to be a little bit more efficient, but let's see if we can get 180. If we want it to be $500 or more, maybe 3 contracts of this one. So let's see if we get that. Can see it up here, it's in the working orders. I don't wanna wait, this is a live stream, so let's just pay too much and see if we can get this done. So no, not yet. And this is kind of why you do it as well, because this is just a trading software. There's nothing saying that everything is visibly accurate, right? Sometimes you will find that you're looking at these prices, it's 183, I'm paying 185, what's going on? Why am I not getting it? It's just it's just a software issue. Sometimes interactive brokers is even worse. I've had trades that you look like you're 20 or 30 cents too high, and it's not going. You can see the natural at 204. So who knows? With a market that's moving so quickly as well, like this is crazy, you never really know if the visual display is going to keep up with what's actually happening in the market. But there we go. We got that second trade. Let's block that one off. And then the third trade that I want to introduce to people, and for some reason this isn't popular, but as you know, if you follow my work, you know where I'm going. What about a butterfly, right? I don't know why people don't trade butterflies more than they do, but it's one of my personal favorites, especially on volatility products, and I'm going to show you what that looks like. So the third trade, we are going to open a butterfly head-to-head, and what a butterfly is, If I just mock one up here really quickly, again, I can't use the same strikes. So let's do a, I don't know, looks like let's do the 40. I don't know what I want to do. I mean, ordinary, let's do the 46. Who cares? So let's do the butterfly. Again, these are not exactly what I would do if I was trading on my own. I am kind of fudging this a little bit because we're doing a live stream. But let's do the 46, 51, 41, right? We're not using any of the same strikes. A butterfly looks like this. Now, I could actually even widen this out. I could go 54 to 38, something like that. So this is what a butterfly, and here's the price right here. Of course, we are expecting VXX to go down into this profit range. We are not paying very much, and we have a much larger payout if we actually get this thing. So this is 217. I could probably do almost 3 contracts of it. That'd be a little too much. Let's do 2 right there. Paying 434 to potentially make over 1,000. This is why butterflies are great, because you're now targeting, as I always say, the Wayne Gretzky quote, you skate to where the puck is going to be, not to where it currently is right now. When you're talking about VXX or any of these volatility products, we are trying to skate to where the puck is going to be, which most likely 3 months from now, it's going to be back down pretty low. But the benefit here, if you look at the construction, we've got some shorts in here. And in fact, the middle strike at 46 has some strong short volatility. So what about the Vega? Well, that's theta. What about the Vega? You can see it's actually Vega negative. So what we've done here, long put option, super strong Vega positive. On a day where the VIX is up 50%, it's going to be very difficult to profit from that trade. Even if it goes down, directionally I'm correct, I'm probably going to get hammered on that Vega when it gets sucked out of those options. The second one, the vertical spread, delta neutral, delta negative, so that's good. But the Vega's somewhat neutral. It's not going to kill me, but it's a neutral trade. It's almost purely directional. Butterfly, again, delta negative. The directional is still going over that 40 range, somewhere, 38 to 45, somewhere in there. But now I'm actually Vega negative. So this butterfly trade could actually do pretty well. Let's open this one. And this one is kind of, a butterfly option on a fast moving market when there was just a reverse split done. We really don't know how liquid this is going to be. So 38, 46, 54. Let's try the butterfly here, and we'll see how it goes. 38, we went 2 contracts. 46, what did I say? 53, I believe, didn't I? 38, is that equidistant? There's 7, no, what did I say? Let's get this right for sure. I don't want to, on a live stream, get it wrong. 54, of course. Okay, so let's get that to 54. Now, it did say around 217, mid. I'm just going to see what happens. This could be a very wide range, but we'll see. So there we go. What did I get? I got 1 contract done. It's still thinking about the next one. I tried for, what did I get that for? Filled orders. I got it for 217. Let's just not waste any time, because the point today is to get these comparisons done. So I don't know, 225. Let's just get this stupid trade done. Don't you hate when you get 1 contract filled and then the other one doesn't fill and you think, am I supposed to sit here? Am I supposed to wait? I typically just do my 30-second rule, make my adjustments, and keep going. Okay, so that's what we're thinking. So now we've got 3 trades open, and we can actually compare those over time. So like I said, let's just highlight these really quickly. I would imagine most people today, at least before you watched my live stream, you were probably the person that did this. You did a long put option on the VXX, thinking, of course, and you're probably going to be right, thinking that it's going to go down this way. I would wish you luck if you're already in that trade, but like I said, I probably just threw that money away. The second trade that I think is a much better trade was the 45-40 vertical. Even though you can't make quite as much, like let's say the VXX went super low, 25, the long put option would make more money. But if it's anywhere in this range, the vertical will make more, and I'm not going to get killed on that volatility. So I've got pretty good hopes for that trade. And then, of course, the ones that I really like for me personally, I like butterfly options because, you're paying very little. If you get them right, you can actually do pretty well with these. And what I like to do is layer them. So if you were talking about a longer time frame, let's say 3 years VXX, something like this, you would just be layering your butterflies ahead of where the price is. Again, skate to where the puck's going to be, decaying downward. And you can imagine if you open a bunch of very low dollar butterflies, these are not costing very much, you just open little 1%, little 0.5% trades, leading it all the way down. A lot of them are actually going to be in the money. Some of them are just going to be gone, just write-offs, but a lot of them are going to be in the money. And that's really what trading is all about. For options trading, if you want to actually maximize your return, you're not looking for these giant big winners, like one big trade. What a lot of people ask me is sometimes, okay, now the volatility has spiked, should I just go all in on a vertical option for a year from now? Well, no, of course not, because, I mean, if you're right, great, but you could be wrong. And about 25, 30% of the time, you're going to be wrong. So it's actually going to be very, very costly. What you want to do is you want to have super high trade frequency with very low dollars allocated to each trade, and you just rinse repeat as many trades as you can. So for butterflies, it's actually a really good trade to do that on because they're so cheap. They're extremely capital efficient. So one trade, crapshoot, roll the dice. Who knows where that's going to land? But if I did 10 of them over the next 3 or 4 weeks at different prices and different levels of volatility, now all of a sudden you've got something. So that's what I personally like. And now we've got all 3 of them open. I'll probably revisit this a few times over the next few months. But leave in the comment section which one of those 3 trades you like, which one of them are you going to do, and which one of them do you think is going to make money? Did I throw away my money on that VXX put? I suspect I did. So that's the first subject. I just want to make sure people aren't doing something dumb, right? I've got a video. This is an old video. Let me go to the YouTube channel. Old video. I don't know if anybody cares, but my first ever video with an actual video editor is up there. So it's the inflation video. But from now on, you might see a little differences in my editing style because it's not me. And yeah, I'm not a very good editor and I waste way too much time. But VIX Put Options. I remember, I don't know what I called it. This one here, if you search my YouTube channel, here's why VIX Put Options don't work. It's the same thing. I just went through a whole bunch of numbers actually showing that even though directionally the VIX could go from 60 or 70 back down to 20, you could still end up losing money. So this was actually kind of a popular video back when I did it. 27,000 views. That's one of my better ones. I was basically just talking about the same thing. Let me see if I can. Yeah, because right here, I went through all the numbers, so you definitely want to check out this video. But it's for the exact same concept. You do not want to walk into that Vega headwind, especially on a day like today. You're gonna turn around 2 months from now. You're gonna be emailing me, or you're gonna be, asking me on Twitter, what is going on? The VXX was 60. I opened up a put option. It's at 40 now, and I'm down money. What is going on? I know I'm gonna get those emails. So that's what happened, is that you paid Vega through the roof, and when that comes out of the trade, the value comes out of the option as well. So butterflies, verticals, calendars, iron condors leading ahead. Any one of these trades is going to be far better than a long put option. Remember, long put options are only for lower volatility periods. Long call options, same thing, only for lower volatility periods. They're not totally useless, but you really have to be careful. Okay, what was the next thing I wanted to talk about? I think I had some charts that I wanted to show. These are interesting. Where are we at today? Down 2.26%. So I don't know if things are going to get better or worse here. This is actually super interesting. But one thing that I want to highlight, and this might not be the best day. I might actually do a video on this over the weekend. But here goes. This is the volatility. This is our VTS portfolio. And you can see there's 5 strategies. Now, what I wanted to show is that 3 of these strategies are actually what I call tactical rotation, which means that we are not buy and hold investors. I'm going to be holding short volatility during stable market periods. And I'm going to be cycling out of that into safety positions when volatility is elevated. And we did that last week. So where was the date that we actually did it? Got a lot of windows open here. Where was the date that I actually did that? I don't know. I can't see it here. I don't have that chart in front of me. I think about July 24th, something like that. I'll get to it in a minute. But the point is that I cycle out into safety because I never know what the market is going to do tomorrow, right? Buy and hold is absolutely terrible because while it might be good at certain times, there's nothing wrong with stocks 60, 70% of the time when they're going up. Nothing wrong with that, but they can crash 50, 60% as well. So obviously you have to cycle out into safety. What I wanted to show is, especially on a day like today, when it's actually paying off, what that difference can be. So tactical volatility, we cycled out of short vol and into gold, did that, let's just call it July 24th. I don't actually remember, maybe it was the 25th. We cycled out of the NASDAQ and into utilities. So aside from today, we've been in utilities the entire time. And then in our third strategy, we cycled out of the S&P 500 and into the IYR real estate ETF. So before the market opened, I put together some charts, and we will see it's a more extreme example now because the SVXY absolutely fell off a cliff. But you can see tactical rotation kind of working its magic slowly here. And of course, its big benefit comes if the market actually crashes all out. But here's what it means. So when we cycled out, yeah, the 24th there. So we went into gold, which is the green, and we cycled out of short vol, which is in the black. You can see the differential already in just a week is 8%. Now, I think it's actually about 15, to be honest, because I did this pre-market and SVXY was only down 2%. It's actually down 11% now. Gold was up 1%. It's down 1.6. So there's 7% more. It's actually about 15% difference already in this strategy. So gold is just doing nice and stable, our safety position. SVXY has fallen off a cliff. And I would definitely encourage people. Of course, my live streams are free. You don't have to follow my portfolio, but you do have to have some method of cycling out of aggressive positions and into safety. Because remember, the short vol trade, it's easy money when the market cooperates, but it can go 80% down, 90% down. It can really kill you. And all your progress can be wiped out in a few weeks. So you definitely need to know how to cycle out into safety. So that's that one strategy. The other strategy, defensive rotation, has been doing very well for us. If you want to see the results so far this year, this was about I don't know, 3 weeks ago, it's up 40% already this year. But this strategy, again, same thing, cycled out of the QLD and into the XLU. And this was pre-market. This is probably, God, I'm guessing 15, 16% at least, the differential here. Cycling out of what we normally make a huge profit on, this strategy makes over 30% a year. QLD is our position. That's where the money is mostly made. But the XLU, for safety, it can really actually save us from those massive drawdowns that we all know is coming. Maybe this isn't going to be an epic market crash leading to a recession, but even if the market is down 10, 15, 20%, something in that range, it's just way too costly to stay in those aggressive positions. So we're already up about 15% differential there. And then the third strategy, again, I did this pre-market. Let's just see how this one's behaving. SPY crashed a little bit. IYR was up. I think IYR was up 0.5. Now it's down 0.3. But the SPY was only down 0.5, and now it's down 2.3. So again, probably a 6 or 7% differential here. Bottom line is, if you wanted to understand how I beat the market for so many years, it's not because I crush the market during good times, right? Because I always say, it's actually pretty difficult to beat the stock market when the stocks are just going up. The only way to do that would be that if you were stock picking and you happen to extract the better stocks out of the index, then maybe you could do that. But we only hold, you know, the broad indexes, S&P, NASDAQ, things like that, the ETFs. So it's really difficult to outperform stocks when they're doing well. If they're raging higher, we just ride the trend and we kind of do similar. My advantage comes from cycling out of aggressive positions when we need to and into safety. And you can see already in just in the last 1 week, it's saved us about, 14, 13%, we'll call it, averaged across 3 strategies. Now that could reverse at any time, of course. I'm not doing this as a, hey, look at us. I'm just demonstrating on a day like today. It's pretty obvious why we trade the way we do, because the market's not actually down that much, right? Let's not overreact too much here. The market is barely down already. You can imagine what that differential would start to build to if the market did crash another 10%, another 15%. We could be talking about a very, very large difference that could take multiple years to recover from. So again, you don't have to follow my work. If you do, of course, there's a free trial for everybody. You just go on my website, volatilitytradingstrategies.com, sign up for the free trial. You won't be charged, and you cancel anytime, of course. It won't hurt my feelings. But also, if you're just trading on your own, that's fine too. But you definitely have to know how to cycle out of aggressive positions, because roughly 30% of the time, you're not going to want to be in those. And then again, just for highlights, if things get really, really bad, in the volatility strategy, roughly 2 to 3% of the time, we will actually go long volatility and actually try to profit from a market crash. That would be for a financial crisis, European debt crisis, things that are actually pretty large. I don't know if this is the one. I suspect probably not. Markets have been calm for so long. I think people are just a little bit panicky. I would imagine that this recent market crash, volatility spike, probably going to fade pretty soon. I'd be surprised if this was lasting longer than a few more days, but we'll see. That's why I'm a tactical investor, because I can't see tomorrow, right? My crystal ball is always in the shop. It never works. So I just basically go by what is statistically most likely to happen. Here as well, we move to cash in this position. You don't want to mess with aggressive positions when the VIX is spiking 50%, obviously. And then the third one, again, about 4 to 5% of the time, we can actually go full long volatility and profit from a market crash. We don't get those opportunities often. And as I always say, I don't cheer for the markets to go down. I know that a lot of people get hurt in recessions. A lot of people, lose their jobs, their investment accounts go down. It's actually pretty scary. I would never cheer for a market crash. But if one comes, I know that I'm going to be ready for it, because I can either be in safety positions if it's not too bad, or full-on aggressive, let's capitalize on this crash type of positions. So, yeah, there we go. Today's a whirlwind. Sorry. Give me a little bit of leeway today on the presentation. I threw all this together in the last 30 minutes. What else do we want to look at? Market's down 2.36, so it's actually getting worse. I just tweeted recently that you want to be a little bit careful trying to get in on all this action, because we won't really know what's going to happen, like the market sentiment, until closer to the close, right? It's certainly possible that this all recovers and the market might only be down 1% by the end of the day. It is also possible that this could be something. One thing that leads me to believe that you want to be maybe slightly careful is that at the start of the day, our safety positions were all positive. Gold, real estate, and utilities were all positive. Not hugely, but they were all in the green, and they're all in the red now. Now, they're barely down 0.5, 0.3, something like that. But typically, if something is not a big deal and everybody's being somewhat orderly, you can see on the first day of a big crash that safety positions do well, market doesn't. But if it's a really big deal, sometimes people just sell everything, like including real estate, including gold, including bonds, all those things. You can get one of those sell everything type of panics. I'm not saying that that's what we're seeing here, but I don't know. Don't go too crazy on positioning yourself. I always say you want to wait for confirmation of the trend before acting. You're not going to miss a whole lot by just sitting on your hands and watching it all from the sidelines. If you want to get in there with some action, be smart. Don't walk into the Vega headwind. All those same rules apply. All right, what time is it? That took 35 minutes. You want to see some charts? I just threw these together, just pre-market, just for fun. So where are we at right now? Again, this is probably slightly different, but as of when I made this chart, like maybe an hour ago, this was the 4th largest VXX spike in history on a percentage basis. You can see Volpocalpyse in Feb 2018. That was a bad one. And remember, not that dissimilar to today, to be honest. If you were trading back then on February 5th, 2018, you will remember that the markets opened pretty calm that day. It was not one of those days where you woke up in the morning and the futures were limit down. It was actually a pretty calm day early on. And then it just sort of ramped up, and into the close was just an epic disaster. And of course, for the volatility markets, the volatility ETF space was at that time way larger than the VIX futures market. So it actually totally dwarfed the VIX futures and a massive liquidity crunch. That's why Volpocalpyse happened. But it was actually kind of a ramp up day. It wasn't one of those disaster from the start. So what am I trying to find here? This screenshot. So we'll see. Today's kind of, not exactly the same, but you can see the stock market wasn't down that much on Volpocalpyse. Volatility just kept ramping and ramping. So we won't know until we go into the close. There's the Asian currency crisis in 2007. That was a bad one. VIX spiked, I believe, from something like 11 to 18 that day. So it went from a very low VIX and spiked up pretty high. And then here's today, fourth largest. Now, there's some people who like point moves. That's fine. It depends on what you're trading. Sometimes percent makes more sense. Sometimes points make more sense. On a point basis, it's only up 10 points today. Well, not only, that's a pretty big move, but you can see down there, it's right 16th largest. But the VXX itself, for us volatility ETF traders, again, we're up here at pretty epic disaster levels. August 2nd. Is this going to be a day we all remember? I don't know. Where's Brexit? Somewhere in here. There it is. June 11th, number 2 would be Brexit. March 16th, that was at the very bottom of the COVID stuff. So actually, this wasn't a huge deal anyway. By that time, the market was already down so far, it was just a continuation of the trend. Today is a little bit shocking because it's actually a reversal day where it's been calm for ages. The market was only down 3%, and now it's only down 2.5%, and the VIX is spiking like crazy. So what's the VXX at? Up 24%. UVXY probably 37, 36.5. That's pretty ugly. What's UVIX? It's got to be 50 almost. 48% up. So yeah, anybody who shorts them directly, ouch. I wouldn't do that. Yeah. Should I talk about why percent matters? Points versus percent? Because remember, the VIX index, the VIX is already a percentage, right? A lot of people might think the VIX is a dollar or something like that, but the VIX is a percentage. It's representing the market's forward estimation of S&P 500 moves, right? As represented as an annualized percentage. So when the VIX is, say, 16, that's representing that the market is pricing in, based on S&P 500 options, that the S&P will move plus or minus 16% over the next 1 year. That's what the VIX means. So it's already a percent. So when you say, oh, the VIX is up 50% today, well, you're kind of saying that it's already a percentage and it's up a percentage. Some people think that's a little counterintuitive. The way that I look at it, though, depends what type of trader you are. If you're a regular sort of, variance swap volatility type of guy or S&P 500 options guy, you're probably looking at point moves would make more sense. But if you're trading the volatility ETF market, you have to understand that the starting point of the VIX matters a lot. Like I pointed out, the Asian currency crisis in 2007 went from a very low VIX up to let's say 11 to 18. That's only a 6-point move. That would not register anywhere remotely close to the top 20 moves, right? It's not going to be on this list here. This list is going to be nothing but, the days you would expect, March 16th, March 12th. The market had already fallen off a cliff for 2 or 3 weeks at that point. But when the VIX is 40 or 50, of course, 50 to 60, that's a 10-point move. But on a day where the VIX goes from 50 to 60, that's a little hiccup. The market is not going to panic when that happens. If the VIX goes from 10 to 20, that's also a 10-point move, but that would be absolute market Armageddon. So obviously, when you're looking at percent versus points, it's not just hey, every time I post something on Twitter, here's the VIX is up 50%. Inevitably, a bunch of people are going to roll through and go, what an idiot. He doesn't even know the VIX is already measured in percent. It's not that simple, right? Today is a 10-point move. If the VIX goes from 15 to 25, That's a really big deal, right? And obviously it is, because the VXX is the 4th largest spike in history. That's a really big deal. But if the VIX stays up for, let's say, the next week or two, and it gets to 50, the day it goes from 50 to 60, I mean, is that a big deal? I would say no. But point-wise, it's going to look like a big deal, but it's actually no. What shocks the market is large changes of direction, and it actually really depends where the VIX is starting. So I would say that even though technically speaking, it's a little, nonsensical to measure something that's already a percentage in percent moves, don't listen to those people. They're just trying to be volatility geeks on Twitter. It matters. You can definitely measure VIX in percent moves. So don't feel bad if you're like, oh, the VIX is up 50 and someone laughs at you. Now you can tell them, well, according to that, Asian currency crisis was a non-issue, right? Well, actually, no. It was one of the largest market events in the last 30 years. So there you go. All right, let's get to some of these questions. Here's the first one. Oh yeah, there's a poll. I totally forgot about it. There's a poll there. I just like to know what people's go-to safety positions are. This person says cash. If there was a 5th option, I would have put cash, but there wasn't. I could only put 4, so blame YouTube. I would have put cash. That's a good position. Cash is an active portfolio position. Don't ever forget that. You're not in cash because you don't know what to do. You're in cash because you think cash is actually a better position than any of the alternatives, right? So it is a position. Don't think it's just, avoiding trading. It's not. Sometimes cash is the smartest thing to do. And as it turned out today, at least last I looked, cash actually, so let's just do, obviously SPY is way down. Utilities are down 0.5%. IYR is down 0.3. Gold is down 0.4. So barely negative, but cash actually outperformed every asset class today. So yeah, cash is an active portfolio position. Fed higher for longer. I wonder if they will have to listen to the bond market no matter what. Well, it'll be interesting. I think in general, a lot of us are feeling the same thing about the Fed, the government. Once you start down the road of manipulation, it's actually really difficult to know how you're going to get off that path, because now we've got an election coming up. We've got an economy that is all warped and manipulated. It's a little bit too late to get back to, hey, let's just do free market capitalism. It's really too late for that. So now, who knows what they're going to do or what they even should do. That's why you should never really start down that road of manipulation. You should largely listen to the markets. I understand that you have to smooth a few things out here and there, but your guess is as good as mine. And to be honest, the next president might affect that as well. As you all know, even though there was that, Biden-Kamala swap, I still do think Trump's your next president. So I don't have a dog in the fight. I'm Canadian, but I think if Trump's president, I think there'd be an awful lot of pressure not to do anything with rates. We'll see. If we get a dollar increase over the next few months, then there will probably be problems with banks again. Yeah, it's kind of the same thing. Like, is the dollar even behaving how a quote, free market would want? We don't know. I mean, we're so far down the manipulation road, we're now just guessing based on political posturing what the economy is going to look like. It's maddening. We'll love to hear your theory on why markets started suddenly falling. I don't know. It could be something as simple as it's time. Like, there might not need to be a catalyst. You could say, well, the employment numbers or whatever. Sometimes no. Sometimes things are just extended, right? We've been in such a long, stable market that any little hiccup is going to cause some problems, right? There were probably a lot of large funds out there that got a little ahead of their skis, probably doing a lot of the one-day options or the zero DTE options, doing things like closing out their hedges because the market obviously hasn't gone down for a very long time. And then you get a day where it's down 2%, and everybody panics. VIX goes up 55% on a 2.5% market decline. I suspect that's what's going on, is people just got a little lazy. They forgot that markets go both ways. And today was a little quick reminder. Like I said, we'll see into the close whether people are actually committed to this or not. And certainly next week will be telling as well. But it might not be any catalyst. It could just be, we've been stable for 18 months. it was time. Just to remind people, just to give them a little reminder. Yeah. Hedging matters. Being diversified matters. A lot of people who are on those like quarterly cycles of having to represent something and keep up, and they sometimes don't have long-term thinking. And then this is what happens. You can get a very, very small, relatively small market correction, and, it hits the fan. Any idea on how long, on average, when 210 uninvert will go into recession? So you're talking about the yield curve, the two-year to 10-year inversion. I'm not a macro type investor, and I think you got to be a little bit careful when you're looking at things like this. So the general statistics would be roughly 15 months after the initial inversion would be when the recession officially hits. And that's an average. Sometimes it's 2 months, sometimes it's 36 months. But I think the average is about 15 months, give or take. The problem is you've only got about 6 or 7 occurrences of this happening, and you've only got maybe 1 or 2 occurrences in what we would call a modern market, right? Do we really care what happened in the 70s? The markets and the world and the economy and the government and the Fed, it is so different compared to back then. Why would we even compare to 30 years ago? This is another thing about the volatility metrics, just a little side tangent. They only go back about 20 years, really. I mean, VIX futures launched in March 26, 2004. That's not a whole lot of data. But even if we had VIX futures for 60 years, would I use it in my trading? Do I really care what happened in 1965? I don't really. The market couldn't be more different. So you got to be a little bit careful about this stuff. It gets really clickbait stuff on YouTube, and there's some very smart people. George Gammon, super smart guy. I watch some of his videos. I like a lot of the things he has to say. But people like that, they tend to make videos on these subjects without really putting it in perspective that, yes, it's true if you average out the 7 previous times that we had an inversion, a recession follows 15 months later. It's a pretty reliable indicator in that sense. But we really only have 1 or 2 examples. So I don't know. Getting back to the whole market manipulation thing, I think they can manipulate this thing a lot longer than people realize. So I wouldn't put much faith into it. That's a very, very long way of saying not much faith. New bearded look coming soon. It would actually make you look badass. No, I've never grown a beard, so I'm indifferent. I can't believe I'm going to answer this question. I'm indifferent either way. I not really care what I look like. I've been married, 14 years. I'm indifferent. My wife doesn't like it. And she's Taiwanese. Asians typically, there aren't a whole lot of Asians walking around with beards in Taiwan. So she doesn't like it. If I really wanted it, I would do it. But since I'm indifferent and she doesn't like it, I've kind of just always defaulted to no beard. Even though most of the men these days are doing the beard thing. I've just defaulted to no. However, she left a few days ago. So I've just been extremely lazy and obviously don't care. My wife's gone. And so here I am a few days later. Probably going to hit that decision in a couple of days, whether I'm going to go for it or not. But yeah, I'll see her in a couple of weeks and maybe I'll surprise her. Otherwise, tune in next week to see what happens. I don't care. Beard, no beard. Yeah, I'm married. Who cares? All right. Today we went from XLU to cash. Why do you use GLD in tactical volatility instead of using it in defensive rotation? Could you swap XLU and GLD in the 2 strategies? Absolutely. So essentially what it is we have to isolate several different safety positions. So right now, the only 2 real safety positions in the market, I would say gold is a good one and utilities are a pretty good one. The others that you could put on that list but can suffer in the last few years would be IYR real estate or something like bonds, right? 20-year treasuries, TLT, 7 to 10, the IEF. You could put those on the list as well, but the problem there, and I think I have a chart accessible somewhere here, the problem there is that whenever you've got something with interest rate sensitivity, then it's not really a safety position anymore, is it? Like, bonds should be a safety, real estate should be a safety, but the problem is rates have been going up so fast that there's no way that even if the market crashes, the market crash effect with people cycling out of stocks and into safety is not nearly going to be enough to offset the fact that rates are skyrocketing. So right now we've really only got two safety positions. We've got gold and utilities. And absolutely, if you really wanted to, you could swap those two strategies. It doesn't matter to me. They both serve the same purpose. The reason that I did the XLU in defensive is because we're only holding that one for 15% of trading days, whereas the gold we're holding for about 26% of trading days. And I just felt that with the volatility market, I want to be out of volatility, short volatility, a little more often than I'm out of the NASDAQ, right? So I put the gold at a 26% allocation of trading days, couple that with bookended long-short volatility. I think that fits much better. And results-wise, it does work out better. Defensive rotation, XLU is only a 15%, give or take, long-term, and then we've got this cash position, but we don't have any long volatility. So it's actually being held about 15% of the time. That's why I do it. Now, I could do a little teaser here. You want to tune in next week because I don't have that chart available. All right, no teaser. Forget I said anything. You want to tune in next week, live stream next week. I'm going to talk about how you can actually take the very best part of an ETF out 20% of the time, and that part will actually keep pace with 100% buy and hold. So I've got a bunch of charts to show you there. But yeah, to answer your question really quick, you could sub them out if you wanted to, but I think gold is more suitable when you're holding it for a little bit longer period. But if for some reason you looked at my portfolio and you're following BTS and you're like, I want to put gold in defensive, go for it. Bottom, all this is fake selling in stocks. Could very well be. I mean, fading volatility is not, it's a pretty high probability game, to be honest, because when things crash like this, there's no numbers. I haven't put numbers on it, but probably 80% of the time it's going to be pretty short-lived. Whenever you see the VIX do something like this, it's really not going to be very long before it comes back down. But, of course, with trading, those devastating losses are what really cost people, right? So if you don't fade this move, if you just be a trend follower, you just follow the signals and do what you do, it's possible that we get whipsawed on Monday or Tuesday, something happens and everything reverses, and now my IYR goes down and the SPY goes up. Now gold goes down and short vol does really well. That can happen in a day or two, but then I would cycle right back into the aggressive position. You might lose a few percent there. But losing a few percent, being in the correct safety position, is so much better on those rare times when it could cost you 40 or 50% if you're in the wrong position. So I don't typically do that bottom calling. I don't front run anything. I always wait for confirmation. I listen to my signals, and I'm just in the trades that I'm in. So I suspect you're right. I think that statistically speaking, you're probably in pretty good standing saying that if this isn't the low, it's getting pretty close to the low. But do you really want to take that chance? You know, COVID down 36%, financial crisis down 56%, dot-com bust down 50%, European debt crisis down 20%. You got the China hard landing, you got the flash crash, you've got the, all these things. Volpocalpyse, February 2018, Q4 2018, down 20%. There's enough examples of market turmoil that losing a few percent on whipsaw is well worth, escaping those big crashes. As remember, losses hurt a lot more than gains are beneficial. If you make 10% and lose 10%, make 20%, lose 20%, you're not back to break even, right? You're obviously still down. Okay, would you say the options chain on VXX has figured itself out after the split and then with the big spikes over the past couple days? Yes, I think that those three trades that I took live, I would say that more or less they were accurate. The put option surprised me that you would think that the single leg put option would be the one that was extremely close to the mid, but it's a fast moving market, so I can't really say. But you watched me execute 3 trades live. They all went through pretty decently. So I would say that, yeah, it typically takes a day or two, but I think we're good to go. Just like I said, remember, I don't even know if you probably couldn't even force a trade in, but you're just going to completely ignore the ones that don't say 100, right? Same with UVXY. There's probably still 1 or 2 lingering somewhere here that say, yeah, 20 over 100, 2 over 100. That's 2 reverse splits ago. Obviously, those are dead. But yeah, I thought it went reasonably well. Market down 2.42. So we'll see. Get the popcorn and watch the final 30 minutes. It could be a wild one. You have the butterfly trades in one of your strategies. I do, but it's a little bit different. So I don't want to do this too much, but it's this one. It's called the Volatility Trend Overlay. Now, the benefit here, if you do sign up for your free trial to VTS, there is actually a full volatility trend course that explains exactly how to do these and goes through all of the different aspects of this types of trade. And yeah, it's a pretty extensive course. There's 16 lessons there. You could go through that. But essentially, what this strategy does, I'll go through it just lightning fast if I can. Yeah, let's use the UVXY. It uses broken wing butterflies instead. So short dated, roughly 8 to 22 days. Let's do 14. It would be broken wing butterflies. The reason that I would do a broken wing butterfly is because, oh, the market's moving so fast, these premiums are going to be stupid, right? 43, 33, 30. Okay, let's get one that looks like that. Let's make that 31. No, that's stupid. Okay, so broken wing butterflies like this. If you did a standard butterfly, it's equal on both sides. And what I like to do is I like to break the wing and go down like that. And then again, it's the same thing. I'm trying to get the UVXY to go down over a period of about 8 to 22 days. This is the concept of this strategy. The only way that they lose, because it's a broken wing, I'm transferring all of the risk from here over to here. So if there's a big volatility spike, it is still a short volatility strategy, but now it can't lose any money if volatility spikes. So a day like today, I would have been short volatility in a broken wing butterfly with no high side risk. This is why we do that. You can see how fast this is moving around. You definitely use your 30-second rule if you're opening multi-leg options today. But the point is that it can only lose money if the UVXY goes down so far, so fast, right? Too far, too fast. But the benefit there would be that I've got 3 strategies that far outweigh it that would also be in stocks, double NASDAQ, and short volatility. So if you imagine what would be happening here, the volatility butterfly could actually lose money if the UVXY went down 30%, 20% in a week or 2 weeks. But the other 3 strategies would make far more. What I don't want to do is add risk to my portfolio during down days, right? That's not diversification. I've already got 3 strategies that are net long equities, net short vol most of the time. I don't need more short volatility. So it is a short vol strategy, but I'm actually flipping the risk upside down. So this is, again, I don't know why. I'm literally the only person on the internet that talks about UVXY broken wing butterflies, but it's just a great pairing of a portfolio that most of the time is net long equities, right? Why would I need more of that? I can just use a leveraged ETF if I really wanted more long equities. Use the SSO instead of the SPY, right? Use TQQQ instead of QLD. There's always ways to easily add leverage. There's very few ways to short volatility with no risk. So this is what that strategy is. That was a minute explanation, but if you want a full detailed one, there is a full course at VTS. If you subscribe, there's many courses in your library, and that's one of them. So I do. Was that your question? Where's your question? Did I lose it? I think your question's gone. I did this one. Your question's gone. This is the thing about YouTube. People don't understand how frustrating YouTube is when it comes to comments. I don't know why YouTube deletes comments. I really, really don't know. Nobody knows. This is a constant problem with creators on YouTube. I've seen thousands of videos on YouTube of people saying, I didn't delete your comment. I don't know what, but the commenter thinks that, oh, I must have really got him with a zinger, right? No, it's just, I don't know what YouTube does, honestly. It seems based, I mean, I'm a subscriber to what's called vidIQ. They basically specialize in YouTube stuff because I suck at all of this. They basically say that 90% of comments get through, 10% don't, and we have no idea why. So there you go. Your comment is now, I wonder if it's showing on the YouTube because it's not here on my software anymore. But that's your question. Yes, we do UVXY butterflies. What's the best way to short the VIX with leverage? I want -2 times. Yes, I know the risks. Well, the problem that you're facing is that you can't obviously just short the VIX. If you wanted a direct VIX, you're talking about VIX options, but they settle to VIX futures. So there's really no way to get direct exposure to shorting the VIX, as you say. Shorting volatility, typically the best ways to do that would be S&P 500 options market, VIX futures, VIX options, kind of the three that you have. You want 2 times leverage. You can't, again, 2 times the VIX. There's no way to do that. But basically what you're saying is you want an aggressive short VIX position. What I would do, what you could do, because again, you're entering the trade when volatility is very high. So the last thing in the world you want to do is load up on Vega. Perhaps you would look at an out-of-the-money iron condor if you wanted to really, if you really were sure that you're going to fade the VIX. That's a trade that would be quite beneficial, fading the VIX. Same with that butterfly that I opened. When you're talking about the short strikes being at the center of that butterfly, that means that as soon as volatility sucks out of the market, even if the price doesn't change, you could already be well up on that position. So I would say that's what you're looking at. Some type of out-of-the-money VIX option, something like that, or go to the VXX or the UVXY and lead it down. 40 for the VXX seems reasonable over the next 2 months. And options are super efficient, right? You're not going to use the full capital. So you said you want leverage. You can always add more option contracts. It's never going to put you into a margin problem with your account. They're so efficient, especially butterflies, extremely efficient trade. You can have all the leverage you want. You can 10 times, 20 times. Don't do that, but there you go. That's what I would say is you're definitely looking for at minimum Vega neutral, but probably Vega negative, and delta negative, of course, strongly delta negative, because the VIX could be 16, a month from now. We just don't know. Okay, asking because the option chain. I don't know where this is. Oh, that's the same. Sorry, I got confused there. You asked previously whether the option chain is fixed, and I would say yes. Asking because the option chain has now moved from 50 cents increments to $5 spreads. Well, remember, the spread doesn't really matter. You are looking for the mid. What it shows you on the front end of your software isn't really what's going on behind the scenes. So volatility products, VXX and UVXY, are plenty liquid enough. I mean, for retail traders, we're not talking about trying to put $10 million through it or anything. If you are, then you might have a problem, but might have to go to the VIX futures. If you're a really big trader, futures are always going to be efficient, right? But yeah, for us normal retail people, VXX is plenty liquid. Don't worry about that. Does it make sense to dollar cost average into SVIX or SVXY after a spike like today? I can't answer that. In general, no. Clearly, no. There's so many low-hanging fruit ways to know when to exit short vol and move into something else or move into cash that trying to do anything buy and hold, why would you even bother? I mean, if I were to just tell you flat out, don't short volatility when the VIX futures are in backwardation. Done. Your drawdowns are going to be cut in half just based on that. So why would you be trying to find ways to make buy and hold work when it's totally not necessary? There are ways, like dollar cost averaging over a long enough time horizon probably can't lose, right? As we know how these products move around, probably not. But then you get something like SVIX, if it traded back in 2018 and 2020, it might not be anywhere near break even yet. So you got to factor that in. I would say no, why bother? But you added that little thing after the spike today. That helps. I mean, if you really are dead set on dollar cost average buy and hold on volatility, which is a terrible idea, if you're really set on it, then yeah, you'd want to start your position on a spike day or on a 3-week long spike, right? That would be a good initiation point. But no, why would you do that? You don't have to be nearly as sophisticated as I am with my strategies. You can just do basic stuff and you'll know that you shouldn't always be short volatility. There's a million ways you can clean that up a little bit. So, all right. At least I feel like I've already missed something. Thanks, at least in part because of your work, I managed to sidestep this crash. Awesome. Yeah. So far, we all have. But I have 2 questions. I know you're only looking at the numbers. How did you deal with anomalies like M3? Oh, he's talking about the election bump in the VIX futures. It's actually less pronounced. It's less visible today because it's a nightmare. So let's just, just to get everybody up to speed. Whenever you've got a set date on the calendar, you're going to have a pretty big kink on the expiration that expires before the election. So for VIX futures this time around, the election's in early November. It's actually the October month that's going to have all the action. So this big kink. Getting to your question, it means nothing, right? With respect to my signals, I'm not looking at anything that doesn't have smoothing and moving averages and momentum changes. I'm not looking at any absolute numbers. So I do not care if this one says 16 and this one says 20. I'm only interested in how they are changing over time in relation to each other and also in relation over multiple time frames. So the absolute nominal values, totally irrelevant. But to take that a step further, with respect to the volatility ETFs, it's also irrelevant. There are a lot of people, and I've got a video coming soon, I promise. There are a lot of people, for some reason, they think that because the volatility products are daily rebalancing, that they're selling something that's cheap and they're buying something that's expensive, and they think this is why they're going down long term. That is not what is happening. It doesn't matter if this one said 100 and this one says 16. That daily rebalancing has absolutely zero effect on the price of the VXX. None at all. All you're doing is selling this and you're taking whatever value it was in dollars and you're moving that exact dollar value over to this future. Nothing changed hands. The number of futures would be dramatically different, right? You're selling something that's cheap, you're buying something that's expensive. You might only be able to buy a fraction of the number of shares, but the dollar nominal value, the notional value, it doesn't change if you move something from one pile to the other. So the volatility products only change value based on the actual movement of both of those futures, not the daily rebalancing. As I used my coffee example, the daily rebalancing is this. I still have the same amount of coffee in my cup. The only thing that could affect the amount of coffee in my cup is if I drink it. If I open it and it evaporates over the next one day, that might affect the coffee. But just moving something from one pile to the other has absolutely no effect on the price, right? Look at the difference between Apple and Tesla stock, right? Let's say you have $100,000 in Apple and you think, well, today's the flip point. From now on, Tesla's going to outperform Apple. So you sell all of your Apple shares and you buy all of the Tesla shares. In that transaction, did anything happen to your $100,000? No. The number of shares in Tesla would be different than the number of shares you have in Apple, but you still have the $100,000. The only thing that affects your 100 grand is what happens to Tesla the moment after you make that daily rebalancing. Now you're on the hook for whatever Tesla's going to do. But just moving from Apple to Tesla, moving from M2 to M3, moving from M1 to M2, you're just moving a notional value that doesn't change from one to the other. So that's probably not even close to what you're asking, but Little pet peeve of mine where people think that, oh, I can see the volatility products decay and it's because they're selling this cheap one and buying an expensive one. And if you do that every day, boy, it's going to be costly. No, it's not even 1 penny costly. That's not what happens. What happens is the other 23 hours, 59 minutes, and 59 seconds of actual decay when the roll yield of those futures is approaching the VIX index. That's going to affect the VXX price. But no, we do not care about dealing with M3. As long as you're not looking at nominal numbers in your trading and only looking at relative differences and relative changes, none of this matters. Hope I got something close to an answer to your question there. Sometimes on a live stream, you get me going and I'm off somewhere else. Okay, indeed. Higher correlation going up everywhere is often indicative of a real crash. Yes, very true. You'd want to watch that. All 3 safety positions being up about 0.5 to 1% in the first hour. Now all of them down. None of them crashing, but if you get to the point where people are just like, whatever's in my portfolio is got to go today, that might be a sign that we are looking for something that has a little bit of staying power. Right now, I'm still leaning towards, and it won't affect my trading. It does not affect my signals. I am not discretionary. My options trading is discretionary, but these are systematic strategies. I'll just wake up Monday and see where we're at. But I suspect this is going to be short-lived. Just my hunch. Could the same thing happen today for SVIX? What happened to SVXY back in 2018? Okay, so you mean XIV. Well, SVXY as well. SVXY in February 5th, 2018 was a -1 times product. So it was materially identical to the old XIV. It's just SVXY is an ETF and XIV was an ETN. Doesn't really affect the markets. They both crashed 96% in a single day. But that's not because of the movement of the VIX futures themselves. That was because of a liquidity problem that the volatility market became so big in comparison to the underlying futures that they're trading that when that daily rebalancing happened, all of the leveraged and inverse products have to do the rebalancing. People think, well, shouldn't they all cancel each other out? The long products and the short products, they should cancel each other out, right? You have to remember that all of them are buying the same futures. So long volatility ETFs, they have to buy futures at the end of the day to maintain their 1 times long exposure. And the short products, the inverse products, they also have to buy futures to do the same thing, to rebalance everything, right? Because it's gone down substantially, so they have to level it. So they're all actually buying the same futures, and it was like $5 billion going through a relatively small VIX futures market. That's what happened. So could it happen again? Technically, yes. But right now, it would be nearly impossible. A, because the volatility space was decimated and it hasn't really come back. What have we got? Maybe 1.5 billion if you include all of them. That's not nearly enough to cause a problem. And B, the underlying index, the SPVIX STR index that they're based on, that was somewhat fixed as well. They've broadened the rebalancing window a little bit. They've used a trade at settlement market. They've increased the bid-ask spreads. So you've got a situation where the index is a little bit better. Then the SVIX is using a different index, the short vol index, and the market is much smaller. So all in all, I'm not going to say no, it couldn't happen, but, basically no, it couldn't happen now. You'd want to be careful if the short vol trade comes back with a vengeance and all these products start suddenly getting $1 billion, $1.5 billion under management, then you'd start to look for something like that. But overall, no. Yeah. I'm going to say no. In fact, I shouldn't have highlighted that. I wanted to say one more thing. Whenever people ask about this question, something to do with volatility ETPs terminating, 100% of the time, and no offense to you, but 100% of the time they use the example of SVIX and SVXY. And that's because those are inverse products. So people think, well, those are the ones that are going to terminate because, of course, the VIX futures spike up and the inverse products are the ones that get crushed. You've got to remember that long volatility ETFs can also terminate. We've never seen it happen, but they could. That, if the VIX futures spike down right? The inverse products are in trouble if they spike up on a day like today or a day like Volpocalpyse where the VIX was up 116%. But what about the next day when the market absorbs all the information and thinks, well, this is nothing. We all completely overreacted. And that VX30, the combination of M1 and M2 futures, what if that collapses? Well, it's going to have to collapse really, really far to crash something like VXX. But UVXY is 1.5 times leverage. So it could actually terminate UVXY the day after a large volatility spike. And UVIX is 2 times long vol. Those futures don't have to move very much to actually terminate something like that. So you got to remember that even though we are all so programmed to fear the spike, if you're talking about volatility ETFs, they can all terminate. It's the same ratios. It's the same thing. They're plus and minus. This thing crashes today, volatility crush the next day. Volatility crush could be a problem. So side note, side tangent, but don't forget, the other ones can terminate as well. Now, again, I don't think that that's going to happen, but there you go. Why not a bearish broken wing butterfly on VXX? Yeah, you could, but the problem here is that if the volatility crush gets sucked out of the market, you're talking about a, 10 or 15 point move? Like it could really, really, you don't want to initiate them now because I have no idea how far the UVXY is going to go down if we wake up Monday and everybody's just forgotten about it. They're like, well, this is nothing. Market's going to go back to all-time highs in 4 or 5 days. And the UVXY could be down so far that, remember, our risk is that way, down to the left, delta neutral or delta negative. So typically I will hang out a little bit and I will wait until I see some decent volatility crush on the other side. Like you wouldn't want to open one here because this initial volatility crush can be devastating on a broken wing butterfly. You'd want to initiate it somewhere here where it's already leveled out a little bit. Doesn't mean it couldn't go down further, but you definitely don't want to set yourself up for that. What happens if, a week from now, it's all the way back down to here? I want to wait to see a little bit of bottoming first, and then somewhere in the next few days, I could look to initiate something. But right now, no thanks. Plus, got to remember that strategy benefits because 3 of our other strategies are typically net long equities, net short vol. And that way, if the butterfly loses money, it sucks. Nobody likes to lose money, but the other 3 strategies make way more, especially because one of them's short vol and one of them's 2 times the NASDAQ. So it easily covers the losses. Right now, we're in full safety. So if that butterfly loses money, we're on the hook for a full loss of a butterfly. And it's not devastating. It's only 1% of the portfolio each trade. But why do that when I have no offsetting positions right now? The second I get into QLD or SVXY, I could start thinking about it, but nah, not now. What is your average annual return on investment capital for doing your program? I've been posting performance every month for 15 years, 13 years officially with VTS with live paying clients, and about 2.5 years before that, just with my own money. So over 15 years now. If you want to go onto my website, I can just kind of point you in the right direction. But I do like to avoid talking about performance numbers. Kind of sounds like I don't want to ever be in that Twitter sort of TikTok world of people just trying to pull on people's emotional strings like, hey, subscribe now, you're going to make a fortune. If you want to see the results, they're always on the website. They're updated every month. There's our results. You can do your own digging. But this is our portfolio. These are the 5 strategies. There's videos for the whole portfolio. There's a video for each individual strategy. And then, of course, if you join VTS, there is also, I hope I'm logged in. There we go. There's also courses. So there's a course library for everybody. There's a 30 video Iron Condor course. So there's like 5 hours of Iron Condor content there. There's a tactical volatility course. I already talked about the broken wing butterfly on UVXY course, stock replacement. You get a little welcome package. This one's not done yet. Volatility landscape and volatility dashboard are currently being built right now. We've got, I haven't started those yet. Total portfolio is started. So you get the point. There's a lot of courses as well. But if you would, if you'd like to know performance numbers, I'd prefer you just go check. Short answer, 22% a year. Obviously not every year. We've had 2022, we were down 20%. So it's not like it's a flatline performance, but yeah, I don't like to talk about that too much. Pull on people's emotional strings. People eventually, when they want to get serious about their investing and they're sick of following all these people who are promising the world and under-delivering, people will eventually circle back and find me. So I actually don't do any marketing. I don't do any advertising. I don't have a newsletter that blasts anything out. I don't offer discounts or anything. I don't really do any of that stuff. People know where to find me, and I'm here to help, and I'm here to be the rational, realistic person that targets something that we can actually achieve. You're never going to see me on Twitter talking about pulling out individual trades from our portfolio and saying, look at that, I made 60%, oh my God. Because whenever somebody does that, of course they've got offsetting positions that probably lost money the same day. They're not showing those. They're just pulling out every single little morsel of something positive and posting that to the world, and everything else is skipped. So, people know where to find me. All right. Do you think the extra volatility today is a short squeeze with banks rehedging to bring the SPX back to lower expected move? No. Like I said, there doesn't have to be a catalyst, but I don't think it's anything beyond. The markets have been doing really well for a really long time, and we're down a little bit today, and it freaked a few people out, or maybe it freaked a lot of people out. We haven't been down 2% in a while, right? Down 1%, volatility spiked a little bit, but when it gets to that 2.5% range on the S&P, if we had a market crash 3 months ago, the VIX would not be up 50% today. But we haven't had a market crash in quite a long time, so everybody gets that sudden jolt reminder, oh wow, things go both ways, and I think that's what's happening. So very likely it's going to be faded, and next week we're going to be back to normal. But keep your hedges on if you're a hedging type of person. I don't hedge personally. I cycle completely out into safety. I don't like the buy and hold and then hedge. I think that's super inefficient. I use tactical, and I'm in this ETF and then this one and this one. So we're in full safety. Stay in safety, of course, if you are, because that's what the signals do. We don't front run. I'm not going to guess that Monday is going to recover. I don't play that game. I'll move back into aggressive when the volatility metrics calm down. But gut feeling, this is going to be short-lived. Kind of like my totally useless, doesn't affect my portfolio in any way, shape, or form gut feeling about politics, right? I don't get into the politics game, but of course I've got opinions. And I think I ruffled a few feathers a few weeks ago in our live stream when I was saying that it looks like Trump's going to win. I didn't say I love him. I didn't say I hate him. I didn't say I support him. I didn't say I dislike. I said nothing other than I think Trump's going to win, and people freaked out. So it's a funny thing on social media these days. People, are they reading the first 3 words of an essay and critiquing that? Are they listening to 2 words out of an entire paragraph and critiquing that? Like, just listen to the whole statement, and it's pretty benign, right? People seem to attack when there's nothing to attack, but there's a tangent that nobody asked for. Okay, thanks for sharing your knowledge. Vol premium will continue rising, or it's already capped. Well, there is no cap. It could go to the moon. Like, people think, sometimes I think people say, the VIX caps at 100. It doesn't. It went to 172 in the October 1987 crash. That's using the old S&P 100, but similar calculation. It went 172 intraday, so there is no cap. If this is a legit market crash, what is the S&P down 5% from all-time highs? This is nothing so far. If this turns into a 20% drawdown, yeah, this could go really, really high for 2 or 3 months. If it's a 5-day crash, then any day now it's gonna fix. Is there an ETP 3 times long or short vol? No. No, there isn't. But I saw a filing. Was it 3 times long? Yeah, I think so. I saw a filing for 4 times long ETFs. I think they might even got approved. I I think there's some filings for some 3 times long vol stuff. I don't know. I always say, like, I always remind people that options are super efficient. So if it's leverage you're looking for, you can easily just add more contracts and it still won't put you into margin trouble. So the idea that you have to use some type of packaged product, you can just manage your risk in the options market and take on any leverage factor you want. You can always rebuild that. Or if you were looking to short volatility ETFs, but you wanted to do it with options, our strategy gives those instructions in the daily email. Like you can see here, most people that trade with our community at VTS, they're going to be using the SVXY when we're short vol. It's very easy. It's an ETF. Everybody can buy it. But if you want, you can just use options. And I give trade instructions down here for VXX put options. These are in the money, very long dated, 100 days or longer. And there's a full course explaining all of this. But yeah, you could just buy 2 contracts, or you could use UVXY and buy 3 contracts. And now you're at a 3 times short vol ETF. Couldn't be simpler with stock replacement. You can do whatever you want. You know, you can work with the delta. The delta represents how much that option is going to change value with $1 changes in the underlying. That's what delta stands for. Just throw that on the screen in case people want to kind of follow along. Let me go here. Can everybody see that? Delta is a very easy way to apply different leverage factors. Let's say your option contract on VXX is a 0.5 delta, and you wanted to do a 2 times long VXX put option. You just buy 2 contracts. That's 50 delta times 2, that's 1. So that's going to be a 1 times VXX position. Or you could buy 4 contracts, and now you've got a 2 times short vol position, much like you would be doing if you shorted something like UVIX. But now you're doing it with options and you have a defined risk. If you short UVIX and it spikes, you're screwed. If you actually do it with long UVIX put options or long UVXY put options, your risk is capped. You can't even lose 100%, let alone 200 or 300. And then you can work with those deltas. So if you use UVXY and you did a 0.7 delta and you tripled up the contracts, well, now it's just really, really easy math to do all this. You don't need Wall Street to come out with some product for you. You can actually do it super effectively and way safer if you just do it with the options instead. So I do send out those trade instructions. Every time I'm short vol, I send out the ETF and the option replacement strategy. Just right now we're in safety, so it's cash, but usually that will say an instruction. Okay. How long have we been going? Hour and a half. It's time to cap this. So last question. How different is buy UGL or 2 times GLD on margin? How it's unsafe. You mean UGold, UGLD? Are you trying to compare like the difference between doubling up on a single ETF or just buying the 2 times ETF? I think I've got a much better explanation somewhere. Let me think. I've talked about this a lot. So basically, it ends up to be about the same. A lot of people think it's more efficient to just buy the leverage products and buy less of them, but no, because you've got things like beta slippage, you've got other problems. I think if that's what you're asking, but I don't use the leveraged gold. For some reason, I think UGold is 3 times leverage, isn't it? What's the other one? D gold and UGold? There's some, I don't use them. Gold is just safety for me. So you can see here, this is another thing. I'm not in gold because I think gold is going to go up. This is not a active position like I'm really bullish on gold. This is just a parking spot for capital because it's way too risky right now to be short volatility. So we just park money in gold. It doesn't necessarily mean that now I'm going to try to make a bunch of money with gold. And so, hey, why don't we go 2 times gold? It just doesn't work that way. I hate gold. I really think it's a useless asset class. I mean, honestly, if people want my honest opinion, the little shiny rock is completely stupid. I would never hold gold. I would never actively trade gold for a profit. But as a parking position during mid to high volatility, it serves a really good purpose. So I've just never traded D gold. or U gold or whatever they are called. But no, if it turns out long term, it's basically the same thing. And when you back out beta slippage and fees and various inefficiencies, doing say 3 times the 1 times QQQ versus just the 3 times product TQQQ, kind of the same thing long term. There's really no way to beat that equation. There's a lot of very smart people. I know people think, Wall Street's really stupid. They're not. There's a lot of really smart people, and inefficiencies like that don't really, really exist. So this is interesting. I do 25% of time in U gold, makes 14% a year in this safe position. Oh, the drawdowns would be insane. My position in gold already makes, 5% for that strategy, long-term, 5% CAGR, but that comes with a drawdown of about 20%. So if you're going to start using leverage, yeah, your long-term rate of return will be higher, but now you're putting yourself in a position that if anything goes wrong, you're going to pull the plug. That's the problem with investing, is that there's just too many charts that show A to Z, and it shows a really good rate of return. Like, oh, if I just buy and hold this, I'm going to get 14% or whatever, like you said. You're kind of glossing over those insanely large drawdowns that when it happens in live trading, you're out of there. And whatever happens after that, it will recover, but you're long gone by that point. So it's a moot point in your case. This is another reason why my portfolio absolutely has to have the offsetting options positions. There's no doubt mathematically these 3 strategies perform better. This one's over 30, this one's 30, this one's like 18, this one's 13, this one's 16, I think, something like that, long-term returns. Well, why don't we just skip these 2? They're clearly the weakest ones. Well, with these, the drawdown is significantly less. So sure, if you just looked A to Z, you could just skip all of this and pick the best one. But do you know how many people would pull the plug as soon as we were in a 40% drawdown? They're out of there. And then I come back and I say, well, look, we're back at all-time highs. You should have just held. Well, emotionally, they couldn't have held. So I can't put people in a position where they're going to pull the plug. I have to have a diversified portfolio that is well protected, that's never going to tempt somebody to pull the plug, right? Somewhere around that 30% range for drawdowns, that's pretty much the limit for a lot of people. They can, 10 is nothing, 20 gets, you're starting to sweat if you're 20% down on your net worth. Once you get 25 to 30, people are starting to exit. So that's kind of the range that we're going for. Something inside 25% drawdown at the worst. You're talking about U gold. I mean, it's over 50% drawdown. You're out the door for sure. So for me, that's going to be a no. You don't want to do that. For what? For an extra 4% a year? You're going to introduce a 50% drawdown? It's just, it's not a good way to invest, in my personal opinion. But you use numbers in your question, so that probably means you're already the type of person that crunches numbers. So perhaps you know all this, and you know your risk tolerance, and you know how far you can go. Maybe you've even experienced it. If you think you can sustain the drawdowns of leveraged gold, go for it. I can't. I know I can't, and I know 99% of our community can't either. So you won't see me subbing in leveraged gold or leveraged utilities or leveraged bonds or leveraged. Safety is safety. We're just there to park money because we're not crazy enough to short volatility when the VIX is up 50%, right? We have to go somewhere. And gold's a really good parking spot, but it's long term, it's a pretty garbage asset class. All right, let's leave it there. Today was sort of an impromptu, market is crashing, sky is falling. We can do a last minute update here. What are we looking at? Are we going up or down? That is the big question today. Down 2.1%. Into the close will be a big tell. Again, I suspect we're going to fade soon, but you never know. Let's check some of the safety positions. XLU's a little down. IYR's kind of flat. Gold's slightly down. There's not a whole lot of panic other than specifically in the volatility market. There's really, other than that, it's just a 2% down day on the stocks. No big deal. Who cares? the volatility ETFs, they seem to really care. So this is actually very interesting. All right, so next week, I'm going to circle back and do the 2 topics that I was going to do today. And so who knows when that'll be, probably next Friday. So again, subscribe if you haven't. Half of the people that watch my content are not actually subscribed, even though they keep coming back. Best way to do it is just subscribe so you see the videos. And on your way out the door, give it a like for me. YouTube loves that like. There's 1 dislike. That's cool too. I should always mention, I always say, hey, give me a like. If you want to give me a dislike, that's perfectly fine as well. YouTube actually likes a little bit of controversy. So on a video that I typically do, it's not uncommon to have 100% likes and 0 dislikes. If you want to throw me 20 or 30 dislikes, that actually helps my content get out there more. They actually like that controversy. So you can even give me some hateful comments, and I don't delete comments. So unless YouTube deletes it, you'll see it. And then that's really going to juice the algorithm. So give me a like, or if you hate me, give me a dislike and come back next week. All right. Have a good weekend.